Have you ever pondered, wouldn't it be great to discover a proven strategy that has already raked in millions of dollars for someone else, so I can adopt it and achieve the same level of profitability? Well, what if I were to reveal that there's a millionaire trader who has openly shared his precise trading approach? This very strategy propelled his trading account from a mere $9,100 to a staggering $82 million within just 8 years. Rather than resorting to haphazard tactics scattered across the internet, why not acquaint yourself with and apply an established strategy that has yielded success for another? In this presentation, I'm poised to unveil one such trading methodology. Let's delve right in. You might be inquisitive. Who is this prosperous millionaire trader? What does his strategy entail? Allow me to introduce you to Christian Kolomajai, ladies and gentlemen. Back in 2013, Christian's trading account held a meager sum of $9,100, yet by 2021, it had surged to an impressive $82 million. Undoubtedly, Christian's journey has not always been a bed of roses, mirroring the experiences of many traders, including you and me. During his initial 2 years as a trader, Christian encountered 4 instances of wiping out his trading account. However, he eventually unearthed a breakout strategy coupled with a robust risk management system, propelling him to amass tens of millions of dollars in the subsequent years. Their risk management protocol is as straightforward as this. Firstly, never retain more than 30% of a position overnight. Secondly, ensure all positions range between 10 and 25% of the account size. Thirdly, the risk per position should fall between 0.25% and 1%. While Christian mentioned that during the initial phases of his trading account when it was considerably smaller, the risk per position ranged between 0.5% and 1.5%. Now, let's delve into the breakout strategy he employs for trading. This strategy employs a swing trading framework ideally suited for the daily time frame. The fundamental concept revolves around the stair-step movement of stocks. According to Christian, stocks generally make a 20 to 50% movement in a single direction, followed by a retracement and sideways movement before embarking on another leg of the journey. In essence, he tends to seek price movements ranging from 30 to 100%, spanning a period of 1 to 3 months. For instance, consider the daily chart of MSFT, which corresponds to Microsoft. Let's integrate some mobile media onto the chart. To achieve this, navigate to the Indicators tab within TradingView and input Exponential Moving Average. Click on it thrice as we'll need 3 instances. Subsequently, let's customize the settings for each indicator. Starting with the first one, click here and navigate to the Inputs tab, adjusting the length to 10. Proceed to the Style tab and alter the color to a light blue hue, then confirm the changes. Repeat the same procedure for the second EMA, adjusting the length to 20 and modifying the color to light green. Enhance the thickness slightly by selecting this option, then confirm. Lastly, for the third EMA, set the length to 50 and designate a green hue for the color. Amplify the thickness by clicking here and confirming the adjustments. These indicators serve to validate trading ranges in the market, particularly when prices fluctuate between EMAs, as depicted here. This essentially suggests that the market is consolidating or moving sideways. Now let's examine the prerequisites for implementing this strategy, according to Christian. His initial step involves scouting for a substantial upward price surge, ranging from 30 to 100%, ideally spanning 1 to 3 months. The second criterion entails the price reverting to a consolidation or lateral movement phase, which can persist for a duration of 2 weeks to 2 months. Within this consolidation phase, it is imperative that the price discovers support among one of the 3 moving averages, similar to the instance observed here. Subsequently, Christian adopts a patient stance, awaiting the commencement of a breakout from the consolidation phase before promptly initiating a long trade. This particular illustration serves as the juncture for executing a long trade. The protective stop-loss order is positioned at the nadir of the trading day, as depicted. Notably, Christian incorporates the scope of price fluctuations to ensure a judicious risk-reward ratio. For instance, if a stock's price possesses an average true range of 3%, the stop-loss should never exceed this threshold. In terms of risk management, Christian adheres to a practice of typically liquidating a third or half of his positions within 3 to 5 days of going live. He subsequently adjusts the stop-loss to the break-even point. As market prices advance, the stop-loss is meticulously monitored in accordance with the 10 or 20-day moving average, contingent upon the level of price volatility. In this specific case, the tracking methodology is pegged to the 20-day moving average. Thus, should the price conclude a trading day below this moving average, it triggers the sale of the remaining positions. As depicted, the instance of selling half of the positions transpired after 5 days, coinciding with the closure of the mentioned candle. Consequently, the risk-reward ratio at this juncture equates to 1 to 1.33, yielding a profit amounting to half of 7.37%. Notably, the price's closure below the 20-day exponential moving average, EMA, prompts the liquidation of the residual positions. In such a scenario, the risk-reward ratio stands at 1 to 5.67, with the corresponding profit being half thereof. Now let's delve into another exemplar. Presented is the daily chart of Axon, symbolizing Axon Enterprise. Initially, a substantial price surge of 78% materialized, fittingly aligning with the 30 to 100% range advocated by Christian. Further analysis reveals that this bullish surge endured for a precisely 36-day span, consistent with the recommended 1 to 3 months. Subsequently, a price retracement transpired, encapsulating a trading range lasting exactly 28 days, harmonizing with the advised 2-week to 2-month interval. Notably, the price sought support at the 20-day moving average during this consolidation phase. Upon identifying a breakout from the consolidation phase, a long trade is promptly enacted at this juncture. The protective stop-loss order is positioned at the lowest point of the given day's trading range, as indicated. Moreover, a partial liquidation of 50% of the total positions is executed after 5 days, coinciding with the termination of the depicted candle. This yields a risk-reward ratio of 1 to 4.62, with the corresponding profit equating to half thereof. Evidently, the price's closure below the 20-day EMA prompts the divestment of the remaining positions. In this scenario, the risk-reward ratio is computed at 1 to 8.87, with the associated profit being half thereof. This strategy, despite its apparent simplicity, has proven remarkably effective, to the extent that even a novice could execute it. Christian's remarkable success can be attributed to his emphasis on balancing low risk against high reward. He asserts that the essence of this strategy boils down to achieving returns between 5 to 20 times the initial risk. A remarkable aspect is that even with a win rate as modest as 25 to 30%, substantial profitability can be attained. The underlying principle revolves around minimizing losses and capitalizing on significant gains. Although a degree of subjectivity exists in non-indicator-based strategies such as this, mastery comes with practice and experience. This holds true if you intend to incorporate this strategy. If you found this presentation valuable, do consider showing your appreciation by hitting the like button and subscribing. Your support is greatly appreciated. Thank you for tuning in, and until next time.